Market psychology is one of the most important factors of trading if you want to understand why the market is doing what it's doing. If the longs are underwater, they're going to respond very differently than if they were, in heavy profit. It's the natural ebb and flow of the markets and the people and machines that make it up. Hey there, John Henry here, SSFTG. Welcome to the video. If this is your first time on the channel, welcome, my friend. I hope to earn your like and subscription today. Candle by candle market psychology is a way for us to go very literally, candle by candle by candle, to better understand what's going on and why. Are the bulls heavily vested and long? Are shorts getting squeezed? What's going on, and how will that impact how the market responds? Before we begin, though, of course, we've got to do a perspective check to see what's going on in the bigger picture. And right out of the gates, we can see that this market has been getting obliterated for the last few days, but now, curiously enough, we have a very big gap to the upside that left the previous day's range, really. It just kind of got stuck as a range and couldn't accomplish much else outside of that. Now, notably, after that, we've kind of gapped down into today's first candle of the day. And within that first candle of the day, we're also opening within this zone of wick support down here, which seems to be like the market is attempting to get something off of that. So if we catalog that right through here, we can see that the market's getting some responsiveness, at least in that area. Now, the bulls are trying to get something to step up to the plate here, but the first candle of the day's got a whole lot of wick on the high that doesn't exactly give a lot of confidence. Not to say that the bulls won't keep trying to rally back to the upside, but if they're going to buy in, they're not going to want to do it above the bull bar's high. That looks like a terrible spot to do it. In fact, what would be a lot more beneficial would be for them to buy back at the structural support area. Get the dip, bounce it back up around there. That reduces their overall risk and also increases the overall chances, because of the previous support, that they've got defense to back them up. As we go into bar 2, okay, we can see that we've got an inside bar that doesn't really accomplish a whole lot. It does pull back on itself, and this is where, again, we can see a lot of the wick stacking up. Bulls are buying, but they just don't want to buy way the heck up here. They want to buy down here on the dip. They want to buy better prices. They want to bring their risk down a little bit closer. They don't want to risk their entire account because they feel like going long in a zone of support because the actual stop zone's too far away. So they need to wait for a better opportunity, and this is their opportunity to buy into this move. It's an inside bear bar, doesn't really prove much. One thing that is for sure is that the bulls have tried to get something going here, and if they bought up at the top, they're likely going to get stopped out sooner than later. All of their stops are going to be underneath the low, and we already know that Goldman loves hanging out at those bases to pick them back up. So if longs did buy here and buyers didn't use this as an opportunity to buy the dip, then a cycle back down would likely find sellers getting stopped out, buyers getting stopped out and sellers shoving the market down through the low for, at the very least, a little bit of a scalp. All right, we do get a pretty strong bear bar down, but notice the inside movement here. Remember, at one point, this was a bull bar. So we do know that the buyers bought the dip, pushed it back up again. Right? They got their moves. It doesn't have to be very big if they're only scalping a point or two. And if the bears try to get the breakdown, they also have a very nice breakdown move. We've got a lot of bearishes stacking up, and all of the bulls who tried to get something going here have now proof that they're wrong. We've made a new low, and not just a new low today, but a new low beyond yesterday's swing low as well. We're invalidating a lot of stuff. If the market's going to return back up to any point, likely at the top of this area where they were buying, that's going to be where they start exiting for break-evens and push the market back down again. And there's that break-even candle. Jeez, oh Pete's, they went all the way up to the high closes and opens. Huge rejection. So even traders who bought way up at the top still were given a chance to get out at break-even. Incredibly forgiving the market can be sometimes. Obviously, after they were given that chance to get out at break-even, if they didn't take that opportunity, they got dumpstered, which means that this is very likely now going to be a squeeze to the downside. If the bulls were long and didn't take this opportunity to get out, likely that they're going to be looking for a break to the downside. At the very least, down to 44.37 quarter, if not a 1-to-1 move, a little bit further down towards 33. Or, or all the way down to the 2-to-1. What's the next one at? 24.5? Jeez. Huge move to the downside. This fulfills basically every short objective on the way down and flushes all of those longs out of the way. They were given their chance. If they didn't take it, well, it got real expensive real fast. How the market responds to this slide to the downside is going to be very important, because now we're starting to break away underneath the previous day's structure, and the only thing that's left is maybe some support on the previous swing or a gap fill. And this thing is way far away from any of that happening. Bulls who are interested in buying the previous day's low to rotate this back up are going to be very interested while it's underneath the previous swing. But the concern is, how wide does the risk have to be? Where's the stop? I mean, the only swing they've got is this right now. Very, very challenging from that perspective. We go into the next candle, very weak bull bar. It's not really showing a whole lot. The bears are getting a lot of targets filled, but they're not getting any follow through. Maybe they start exiting if it doesn't really want to break down again. If it starts pulling back a little bit too far, they'll start hitting the exits because they're already beyond their 1-to-1 targets, their 1/2-to-1 scalps. They're past them all. We get another continuation back up. Look what happened when it went back underneath the low. Those sellers went, no thanks, I'm out, and they cut their positions. They did close directly on top of the 1-to-1 target, but there are some concerns that this may have a bit more follow through to the upside. If sellers haven't had a chance to get in, they're going to be waiting for a way to get in too. And what better spot than just above a horrendous looking bull bar? Sure, it's an engulfing bull bar, but what did it really accomplish? Not much. This doesn't prove strength at all. So if it can get above this bull bar's high, that's where the shorts are going to start looking to pressure back down again. They couldn't quite get back above that high. There's even more wick. You can see all the failures going on here. Starting to create a small little body channel as well. The market is getting consolidated. The sellers aren't necessarily following through anymore, but the bulls aren't getting their bounce. There are very likely some longs who were up here that are still stuck, and they didn't get their opportunity to exit, or they didn't take that opportunity to exit, and now they got dumped on. So if we consider that entry point all the way down to a new low, and they bought a new low, where's the halfway point between those points? All right, we'll go to the top of support, down to the lows, and the halfway line is right there on top of everything else. So if the longs did average in to get out at break even, that happens at the exact same price. Now, you want to talk about stacking the odds. That's a really good way to do it, but we'll see if they can even pulse up there. Okay, and there's the response rejection off of that area. The sellers push right back down again. Although it is a weak bear engulfing candle, they have a hard time getting underneath that last level. The rejection and all of the resistance we know stacked up a little bit further. Sellers now are very likely looking for another new low to finish the job if they're able to get it done. And there's the job done. And you can see, look how many of them took profit. When it hit that low, they're done. They pieced out. Big old wick on the bottom. If the next candle's bullish, we're probably going to begin transitioning more sideways because these bears are taking profit. And it's not only bullish, but it's bullish closing back above that major 1-to-1 target. Now remember, if you were short, let's say you shorted here, and you're at your scalp target, you're at your 1-to-1 target, you're looking for the 2-to-1, doesn't quite make it. Maybe hits it, maybe you take it off, maybe you don't. But now we're back above the 1-to-1 target again. A lot of algos, a lot of traders are going to look at that and say, you know what? I'm just going to take that 1-to-1 off the table and not really worry about it. That now is a zone of support that if the sellers are going to win anything, they're going to have to work through it. And there's all that wick support pushing the market back up. Now, we do know that the sell side resistance was there before, but we have to ask ourselves, is it still there? The sellers just failed their rotation underneath the low. It would make a lot more sense that they might want a bit more value. Where the earlier bulls were trying to get in, we know that they had some break-evens here, but how about a little further up this time around? Maybe they can find some better pricing to finish the job. It is also getting a little bit later in the morning here, going into 10:30. Look at this back and forth. I mean, holy cow, you can see the responses directly off of these areas. Ping, 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 back and forth. If they're able to begin invalidating, notice the sellers who were concerned that they weren't going to get a 1-to-1 anymore started exiting at their 1-to-1s. Now we're up at the scalp area. If the market begins getting above this, we're going to see the exact same thing. They can't get above it, though. The bears are trying to put the pressure down. Very likely, we just see more response off the 33s with the earlier sellers exiting. There's the response off 33s. Bulls trying to continue up. Bears say no thank you. They couldn't even get down to a new low. Another test. And another bounce. Man alive, you can see them just playing. Oh, man, they're just jamming each other right in the jaw over here. All of this back and forth. The shorts trying to get something going and realizing they're wrong. Out, get out, break even, get out, get out, get out. Sell a little bit further up, perhaps, to try to draw their average higher. There are some ways that they can make this work, but obviously they're running into some trouble here. And if we go toward the end of the day, which is still actually working, they haven't even been able to make it up here yet. Look at all of this resistance. Candle by candle analysis is by far my favorite method for practice on market research. You learn so much more about the markets and yourself that it makes it immensely valuable for every trader to do. If you have any questions, thoughts, suggestions for new videos, drop them in the comments below. I always love hearing from you all. Thanks for watching, and until the next one, we'll see you all then.